Hello and welcome to IPO Review, and today we are going to talk about an initial public offering of Adani Wilmar. Adani Wilmar IPO will remain open from January 27th to January 31st. The price band has been fixed at rupees 218 to 230 a share. The IPO comprises a fresh issue of new equity shares of face value of rupee 1 for an amount of up to rupees 3,600 crores. Promoters and existing shareholders are not offloading their stake via OFS in the issue. To talk about the issue in detail, I have with me very special guest, Mr. Angshu Mallick, Managing Director and CEO, Adani Wilmar, and Mr. Shrikant Kanhere, Chief Financial Officer, Adani Wilmar. Welcome, gentlemen, to the show.
Thank you. Thank you.
My first question is for Shrikant. Shrikant, why has there been a reduction in the issue size from 4,500 crores to 3,600 crores? Is it because of the uncertainty and the valuation concerns that have been raised by the market participants?
We see the reduction in IPO size has got nothing to do with the valuation or uncertainty in the market. Mm-hmm. See, for an issuer, he is allowed, as per the regulation, to reduce or increase the size of an IPO by 20% from what he filed at the time of DRHP. Mm-hmm. So we filed DRHP with a size of up to 4,500 crore. Okay. And we have exercised that option of reducing the issue size by 20% by around 900 crores. Mm-hmm. Earlier, we had envisaged 900 crores for general corporate purpose, which now we have done away with, just to make the IPO size a more optimum and more effective and efficient. Okay. This will also allow us to ensure that we maintain our return metrics as we go forward. Mm-hmm. And what we have done is, by removing the general corporate purpose of 900 crore, we have stayed only on 4 objects of the IPO, which is more to do with the capex, more to do with the repayment of term loan, and of course, the mergers and acquisition.
Mm-hmm. Mr. Mallick, talking about the utilization of the proceeds, your major focus would be on capex. So what is the kind of capex that you're planning?
See, the major capex is going to come in the food segment. As you know, in oil, we have very good capacities. All India edible oil refining capacity, we hold around 25% of country's capacity. So we are not looking at great investment there, except in East, which is growing faster than any other part of the country. Our capacity utilization in Haldia is almost at 75-80%. So we feel that in 2 years' time, we will run out of capacity. So we are expanding the Haldia unit by another 1,500 tons per day. Rest of the place, we are investing in mustard seed crushing, because as you know, government has given a lot of incentive and promoting self-sufficiency in edible oil and oil seeds. Mustard oil and mustard seed is one of the focus oil seed for the government. And we are seeing there is a big shift from wheat to mustard cultivation, particularly Rajasthan, UP and Haryana. So we feel that we should take this advantage. So we are putting another 1,000-ton mustard seed crushing unit. You are aware that Fortune Kachi Ghani mustard oil is #1 mustard oil in the country. So obviously, to keep up with our demand and the growth that we expect will happen, so we are putting there 1,000-ton crushing, which will give us a sizable capacity. We already have 1,000-ton existing capacity. So put together, we'll have 2,000 tons per day. Now, rest of the money, most of the money is going for rice integrated operations, from paddy to cogen plant, to processing of rice, to rice bran oil extraction, to rice bran oil refinery, to rice bran oil packing. So we will buy paddy and we will give rice and rice bran oil as the final product. So this entire chain, possibly there is no company which is handling end-to-end, and we have the advantage because Adani Wilmar is #1 in rice bran oil. Fortune rice bran oil, as you know, is the #1 brand. So together, this integrated operation will make it a very unique thing. Cogen plant will help us in reducing our power cost, thereby improve our efficiency. We are also putting wheat flour unit in this same unit, so that when we dispatch rice, wheat flour, oil, mustard oil, it will bring lot of efficiency and synergy in distribution, because 65% of our distributors are handling both oil and food. So in the same truck, when I dispatch both oil and food, just imagine a small town like Panipat or even Ambala side and all that. If I dispatch from Gohana, the place that we are putting the plant, it will bring lot of advantage, a faster turnaround of the product. So all these things have been kept in mind. We are also putting integrated plant in other parts to bring more efficiency. So that is what will be the capex maybe.
Good amount of expansion on the card, sir, but consumption side has been an issue. How is demand shaping up both in the urban and the rural areas? Company is in the edible and basic staples. So has the volume been impacted?
Edible oil is a very mature category. And edible oil, branded edible oil or packed edible oil today is around 88% of the market. So fairly matured and fairly well distributed. So edible oil is growing at around 6%, 7% per annum. We are growing little higher than that. This year we will do better. But the major growth we are seeing is branded staples. Today, the staples market hardly is 10 to 12% branded, which biggest share is atta. Branded atta today is the biggest share, but that also is 15%. So 85% of the atta today sold in the country is all loose, or people going to the chakki and getting that milled and all that. But all this is changing very fast. We are growing at around 25% in branded staples since last 2-3 years. And we hope we would continue with this kind of growth rate. We are seeing the similar growth rate this year also. Consumers in COVID have shifted to some extent, at least. We are seeing that grocery buying in e-commerce has improved drastically.
Okay. What is the volume growth like if we talk about the typical volume across your product categories?
Staples will grow at around 25% to 30% per annum in volume terms, and edible oil in the range of 6 to 7%.
Packaged and branded products are being preferred. We all know now that people are becoming very health conscious, and market is very big and it's growing. And shift towards organized from unorganized is helping players like you. So what is the kind of verticals like general trade and modern trade? So how is the revenue distributed among these, and what is the growth that you expect from, and which of the vertical will be actually contributing to the maximum growth?
We have to see the product differently. Edible oil, today 90% of the business comes from the general trade because it's very deeply penetrated, both urban and rural. So 90% comes from general trade, 5% from modern trade. That is the Big Bazaar and Reliance and Walmarts. And 5% comes from the e-commerce, particularly Big Basket and Amazon and Flipkarts. Now, when you look at staples, the situation is a little better. 75% business comes from general trade, 10% from the modern trade, and 15% comes from e-commerce. And this e-commerce business is growing at more than 50% per annum. So in days to come, it will be high. Now, this is at a pan-India level. But when you go to a city, say Bangalore, you take Pune, you take NCR, these are the cities which have very high ratio of e-commerce. There, the e-commerce might be around 40% instead of 15%, because at an all India level, it is 15%, but on a particular city, when you tap, it is different. So our strategy is always on a city to city. We measure our performance. We are the largest selling edible oil brand in e-commerce, although we are number one in India in edible oil, but in e-commerce, we have 30% market share. So their consumers prefer brand in e-commerce. That is what we have seen. They prefer to buy their known brand because they are not checking the product. They just get the delivery at home. So they rely on only few good national brands instead of regional brands.
Mr. Shrikant, on the profitability front, you are doing good. Give us a sense of how margins are shaping up and what do you expect in the future?
See, we have been able to post very good growth on a top line as well as bottom line for last 5 years. If you look at top line CAGR of last 5 years, it's around 11% plus, which is quite good number for any food FMCG company, because growing at a double digit itself is a very good number to talk about.
Mhm.
As far as the bottom line is concerned, our EBITDAs are consistently growing at a 20% CAGR for last 5 years, and we have been able to demonstrate that very well. Thanks to the number one brand which we have. In fact, the brand equity is such that we have been able to go through all these inflationary pressures or any kind of commodity price pressures which we have witnessed in the last couple of years. Our brand is quite strong, and therefore it helps us to get along with any kind of pressure. Now, as we move forward, as Mr. Mallick talked, that the whole focus of the company going forward is going to consolidate our food basket, because today we are very strong edible oil player. We have a sizably okay food basket, and that is something which we are going to take it to the next level. As the food proportion in the revenue keep going up as we move forward, I think the consolidation of margin will be there. But having said that, whatever we have been able to deliver so far, we are very quite optimistic that we will continue to do so.
70% of the raw material is imported. What is the risk management strategy that the company is following, and has it been able to hedge the foreign currency risk effectively, Mr. Shrikant?
Yeah, so we have a very robust integrated risk management policy in place. It's a very robust framework which has been given to us by the board, and it is approved by the board. So we operate within that framework just to ensure that we mitigate all the risk which we are open towards commodity, whether it is currency or even the counterparty risk also. As far as the currency is concerned, we don't take any risk, we don't speculate, because currency is not a commodity. And therefore, we ensure that we keep a hedge ratio of 100% every time, all the time on the currency. As far as the commodity is concerned, there is a framework, as I said. Within that framework, the traders and the sourcers, they operate. And there are hierarchies defined in that policy that if you go beyond these limits, you will have to take an approval from the board or the chairman. And this is also reflective on our numbers also. If you look at our bottom line for last 5 years, we are consistently growing. Our numbers are not like in 1 year you show a very high margin and next year you drop to something very below the average. We are consistently growing thanks to the kind of hedge policy and the risk management which we follow in the company.
Mr. Mallick, how has the export market been so far? Any disruptions that you are facing?
No, export market, one that Fortune as a brand is also known in many countries. We have been exporting since last 10-15 years, so all our brands are registered. Expats staying abroad prefer to buy some of our products which are very Indian in nature. One is basmati rice. Second is some varieties of rice like kolam, sona masuri and others. Third is mustard oil, is a preferred oil in UK, US, Australia, Middle East also. Then soya nuggets is in demand by non-resident Indians abroad. So few of the products, in fact, chakki atta, we have exported to UK, and I'm getting good response from chakki fresh atta, Fortune atta from London. Now, that is because people staying there would like to continue having the same kind of products that they use in India. One. Two, brand which gives them assurance in India also gives them assurance abroad. Third is, this business has been improving. We have also taken the help of Wilmar, Ukraine. Wilmar operates in 90 countries, and they have such type of manufacturing facilities in many countries. like they have in India and Indonesia, Malaysia, Africa, and others. They also had sunflower oil manufacturing at Ukraine. So presently, we are packing Fortune brand sunflower oil in Ukraine at the source and globally exporting from there. So that is one advantage that we get from our joint venture partner. There has been some hiccups in the freight rates, container freight rates, and availability of containers in the last 1 year. Uncertainty of freight rates has been pressure on us, but somehow our exports volumes have improved this year, and we continue to do better in exports this year.
Mr. Shrikant, one last question. What is your take on the commodity pricing, which has been on surge? We have inflationary pressures growing. How much price hike has the company taken as of now, and what is expected as far as the future is concerned for the commodity pricing?
See, as far as the commodity prices and inflation is concerned, we always kept saying, and we also believe that our brand itself is a big hedge for us. So all the commodity price pressures or inflation, we have been able to handle through a proper pricing of our brand, because our brand is able to pass on, this kind of inflationary pressure to the consumer without losing the market share. That's the one part of it. And what you said is right, that we have been witnessing this inflationary pressure and commodity price rise for last couple of years. It was sitting at a peak. But the recent intervention by the government by reducing the duty, I think the prices have already come off by 20-25% from the peak, what we saw sometime in September and October. So these levels, I think, should continue. We don't see much of inflationary pressure now going forward. I think the prices should settle. And it will be helpful for the consumer now to, buy the edible oil and staple food at a reasonably okay price. So our expectation is that at least now, henceforth, the prices would stabilize, as they are already been off by 20-25% from the peak, and thanks to the government intervention by reducing the duty on edible oil.
Thank you, Mr. Mallick, and thank you, Mr. Kanhere, for your time. It was a pleasure speaking with both of you, and we wish you all the best for your IPO.
Thank you. Thank you.
Thank you.
Investments in securities market are subject to market risks. Read all related documents carefully before investing.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.